let's look at 3 undervalued dividend aristocrat stocks. So what is this all combination about? So we're going to look at 3 stocks that are undervalued, looking at their price relative to their book value, the underlying assets of the company. So we're going to look at an undervalued measure and find some that are undervalued. And then dividends, of course, pay us income. And dividend aristocrats are companies that have paid dividends and raised their dividends for many years. In fact, these companies have paid dividends and grown them for decades and decades. So their dividend is pretty safe, even though they're undervalued. Their stock price may be depressed in some cases, and they're going to pay us some dividends. So there might be some good opportunities here. Again, you want to do your own full due diligence, but here's something maybe think about in terms of on your watch list. Oh, and the concepts I'm going to show you are all in my courses. I have a full investing in stocks course down below and a dividend specific course, plus some free course and everything, and sale courses, all sorts of stuff. So check out Investing Education with MrB.com and the courses below. All right, let's start looking at these three stocks that are undervalued dividend paying stocks. And the first one we're looking at here is Stanley Black & Decker. So you may know them for their tools. They make tools, right? Hammers, all sorts of tools. And you can see even today, as I'm recording this, they're down 5%, right? So this is an undervalued stock that's gone down. They've struggled with supply chain issues around with China, and steel, the cost of steel and all that has impacted them because of supply chain and China issues with China now, all the way back to, the Trump administration tariffs and all that. So they struggle with that. But if you look at Stanley Black & Decker, they start showing up in all sorts of top beaten down stocks to buy now, and 2 industrial stocks that are too cheap to ignore. So they're starting to pop up on the radar quite a bit. Let's look at a little closer at them. So first off, of the 3 we're going to look at, they pay the best dividend. They're at a 3.73% dividend yield, which is terrific. Especially if you lock in at that price, you hold it, and it grows over time. Your real yield over time will go up. But basically, locking into a company that might be undervalued with some potential for stock price appreciation and locking in at 3.73 is pretty good if they can keep paying it. This is the thing when companies struggle, can they keep paying it? So we're going to look at that here real quick too. So I'm going to go under statistics here. First, I'm going to look at this price to book, 1.47. For value investors, they're looking for a price relative to the book or underlying assets and value of the company. Underneath 3.0 is good. If you can get to 1.0, especially 1.0, that's amazing. But if you start approaching 1.0, that's good. But if you're under 3.0, for many folks, they would consider that undervalued. To them being at 1.47 for a company that pays dividends, they've paid dividends for over 55 years. Right, so they have not cut their dividend or stopped paying dividends for 55 years. That's pretty solid, right? And so they're undervalued right now. And you can see they're down 51% over the last year compared to the S&P 500 down 12. So you've got some deep value on this one. The other ones won't be as deep of value, but this one might be giving you some deep value. And the last thing I want to say, how safe is that dividend? The fact they've been paying it for 55 years is pretty good. But if we look at their payout ratio, which is under dividends and splits, the payout ratio, that's a little high at 85.68, right? We'd like to see that below 75%, certainly even lower, 50, below, will they keep paying it? Now, Stanley Black & Decker, the last thing they want to do after 55 years is cut the dividend or reduce the dividend. So even though that's a little higher, that's going to be the last thing they'll do. They'll borrow money to pay the dividend if they have to. They have about $408 million in cash, and they are at a current ratio of 1.16. You want that to be above 1.0 to see if they're able to pay their current bills, right? So even though their cash flow is not good right now, a good amount of cash, but not great, but they're able to still pay their bills, still pay the dividend. It's not over 100%, but you're buying something that's undervalued, right? And this is why with that price to book ratio being at 1.47 and a nice dividend yield at that 3.73, this might be something you might want to take a look at. Now, the second one I want to look at is the opposite side of the steel equation of all things, which has been a favorite for many people for a long time, which is Nucor. And Nucor is a steel company. You're like, steel companies? Who invests in steel companies these days? You could say that 20 years ago, 30, 40 years ago. Who's investing in steel companies? Well, people invest in steel companies. And Nucor is a well-managed, well-led steel company. And their dividend's not as high. So you're going to get a 1.31 in that dividend. It's solid. You're going to get a dividend that's been paid paid for 49 years. It's been paid for 49 years. They've raised their dividend for 49 years. So that yield will go up over time. In fact, if you're buying in now and the dividend will rise up, is the idea behind that. And if we look at some of their statistics here, you know, they're, I mean, you look at like their price to earnings ratio, like trailing's 5%, but they're looking at more profits. They're at 10.82, you know, but coming way up, you know, their price relative to their earnings. But price to sales, I mean, this is cheap. It's below 1.0. I mean, if you're looking at a valuation on a price measure, price to book 2.28. Yeah, it's not as low as Stanley Black & Decker, but you're getting a more solid footing company on the other side of the steel equation is able to, you know, get profits from the, you know, limited amount of steel and stuff that's available there. So they're doing very well with that. And that's a nice, attractive, start looking at price to book ratio. Especially when you consider over the last year, they're up 51%. Whoops, they're up 51%. So if you're looking for a company that's doing well and you want to play more of that momentum and have it continue to do well, that's a company that's up 51% versus the S&P 500 down 12, right? So, you know, and even still, even with that dramatic price rise, price to book's at 2.28. That's still pretty undervalued, if you ask me. If we look at their payout ratio, 6.32, right? No problem paying that dividend. They're going to be able to pay that dividend. They got $3.43 billion in cash if they need to draw on that. Their current ratio is 3.10. I mean, they can certainly pay their bills. Plus, they've got really nice billions of dollars of positive cash flow right now. So if you're looking for something that's safer than Stanley Black & Decker, then this would be the guy to go for with that in terms of Nucor. But the flip side, you're going to get less payout on the dividend, but you're going to get a really solid company. And then the last one we'll look at is, I don't know if you like ducks or whatever, that's their mascot. Do you guys know the insurance company whose brand is a duck? And if you do, you would know that it's Aflac, right? Aflac. They have a duck that sells their life insurance. And really what they're known for is their health insurance, supplemental health insurance that goes above and beyond what other plans might cover. So Aflac is going to pay a nice 2.34%. You know, they're an insurance company, so, you know, people need insurance all the time. So, you know, nice 2.34, kind of in between, solid insurance company. And their price to earnings ratio, 9.09, that's not bad. Good earnings per share, so that's good. Let's take a look at their price to book. 1.88, that's pretty good for Aflac. Though you can see it's been even lower, so, you know, it's not been getting the love it really probably deserves. You know, price to sales a little bit more, 2.27 coming up, you know, but still that's still pretty under for its price relative to the earnings it makes. So it makes good earnings, and you can still get a good price, and its book value pretty attractive if we just look at that measure. They're up 16% over the last year versus the S&P 500 down 12. And if we look at their payout ratio, 19.57, right? You know, and they could always reduce staff or raise prices a little bit if they ever got in trouble. But, you know, they've been paying out their dividend for 40 years. 40 years straight paying the dividend and raising the dividend for over 40 years. Low payout ratio. Same deal, kind of like Nucor with $6.5 billion in cash and $3.72 billion in operating cash flow. Though the current ratio is below 1.0, that's a little concerning right now. So you want to dig deeper on that and see if there's any problems with debt or long-term debt that might be coming into short-term debt. You know, so you might want to look at that. But still, you know, that's at 9.5. That looks pretty good on Aflac. So, you know, Aflac might be one to look at too. So there you got kind of like a riskier one in terms of Stanley Black & Decker. In terms their price might keep going down, especially some solid player that pays a higher dividend, a solid player who plays kind of a medium or the lower dividend of 3, which is the Nucor, and then Aflac in between with their 2.34% dividend payout and dividend. And the last two are certainly good, safe ones from the dividend payout strategy. So dig deeper into these. These are not recommendations. These are ideas, something you might want to put on your watch list. But these are companies that are dividend aristocrats. They've paid dividends for over 40 plus years. Stanley Black & Decker, 55 years is the longest. They're not going to, the last thing they want to do is cut the dividend. So it might be a good opportunity to get it when it's undervalued versus a lot of dividend stocks are up in value because you know, people are rotating out of technology stocks right now. And this might be an opportunity opportunity to get into some dividend paying stocks that might be undervalued. Okay, so I hope you liked this video. If you did, certainly click the subscribe button and do check out the courses below. So if there's some terminology and stuff I'm using, you're going to learn about all this stuff and how to pick stocks, whether they're growth stocks, dividend stocks. If you're an active trader or buy and hold investor, we got courses for everyone. So go and take a look at those. With that, I wish you all the best of luck in finding your stocks. And this was kind of interesting too. These three stocks, it's like I can get the hammer. I can get a hammer from Stanley, who the steel's made by a Nucor. And if I hit my thumb with my hammer, well, that's probably going to be covered by Aflac, right? So they all work together in the end. All right, I wish you all the best of luck in your stock choices.